This is part 2 of my invoice finance guide. You'll find a link to the first part in the description below or at the end of this video. Okay, so next thing I wanted to go through was pricing. Now, you can find dramatic differences in pricing between different products and also between different providers within the invoice finance sector. We did some research a while ago and it was into a factoring product for a particular customer, and we found 165% difference between the cheapest quote that we could find them and the most expensive that was on the market. So there's a lot of money to be saved by shopping around and looking for the best rates. Now, the pricing itself is typically structured in the same way across the industry, although there are some variations which I'll go through in a minute. But the way that most pricing works is that you'll have 3 components to it. The first is a service charge, which can also be called an administration charge. The service charge is a percentage of your turnover, and that is charged for providing the facility and the credit control service if you're making use of a factoring facility. The second type of charge is what's called a discount fee. Now, it operates in a similar way to interest that you may have on a loan or an overdraft. It's charged as a percentage over base rate. Now, base rate is a standard rate at which banks lend, and it's a margin above that rate. Now, that creates a percentage which is charged against the funds in use that you draw down on your facility. So the amount of money that you're utilising at any time, you're being charged discount fee against that. The last type of charge is what we would put under the umbrella of other charges. Now, these could be additional fees for things such as if you needed an overpayment and you wanted your invoice finance company to provide funding above what you're already entitled to, they may be able to do that, but they will typically charge an overpayment fee to do so. Okay, so I said there were some variations on how the charging structure works. In some cases, you can go for what's called a single fee structure. Now, that means that rather than having those components of service charge and discount charge, those are combined together and there's just one fee. Now, that may work as a percentage of your turnover, or it may be that it works a similar way to the discount fee as a percentage that's charged on the funds that you're using. So there's 2 possibilities there. Next thing I wanted to cover was funding levels. Again, the amount of funding that you get from an invoice finance facility will vary dramatically between different providers. It also depends a bit on the nature of your business and the sector that you operate in. Something like a construction business, typically the funding percentage is like to be around 70%. So that's a prepayment of 70% against your invoices or applications for payment that you raise within the construction sector. That increases when you look at other sectors, for instance recruitment, which a lot of recruitment businesses use invoice finance. It can be as high as 90, even 95% in that sector. And in some sectors you can get funding at 100%. Now, car body repairs is a good example of that. When people have a car crash and they go to their insurer and their insurer pays for the repair, that is often funded on behalf of the garage that's doing the repair. Now, that could be funded at 100% of its value. So the invoice is purchased outright, less the fee for providing the service. Now, interesting development recently, we've come across a few providers that will actually provide 100% prepayments to a wide range of different sectors. So that level of funding might be possible, that is 100% less the fee, might be possible in your sector, even if you're not dealing with the car repairs that we talked about. Last thing I wanted to go through very briefly is the qualification criteria for invoice finance. It's very simple. If you're a company and you are selling goods or services to other businesses, then you should be able to qualify for some kind of facility. It's not like other forms of lending, things like loans and overdrafts, where you have to have some evidence of profitability of your business. They may even look at your balance sheet to want to see some worth within your company. particularly if you've had negative credit history, things like court judgments against your business or you personally, that can cause problems when you're looking for things like loans and overdrafts. That's not the case with Invoice Finance. Because the facility is based on the strength of your debtor book, even if your business is not financially strong, you may still be able to access funding through factoring and invoice discounting, which are known under the umbrella term of Invoice Finance.